Hey traders, a very warm welcome to you. Okay, so today I'm going to talk about in this video trading biases that cloud our decision making process. Listen, we're human beings, we're not robots, we have to trade according to our human emotions. But there are a few things, and I've just picked out, and I've got here 5 that I think are important that we've got to pay attention to as traders. Let's get the red pen out and let's have a look at them. So number 1 is anchoring or confirmation bias. So in other words, that means when you have seen a trade and you've looked at it and you say, listen, this is very bearish, the chart's bearish, I think I'm going to go short. You go short, then all you do from then on is look only for confirming signals that confirm your initial bias. So you're bearish, you're looking for the downside, you end up self-fulfilling by looking for only things that are bearish, like, oh, that candlestick looks like it's going lower, oh look, there's volume to the downside, oh look, we've done this, do that, rather than looking at it from a neutral perspective and saying, hey listen, I may be short, but is this still a valid short? Is it still a valid short? Do I need to be bullish on this, in which case maybe I need to cover? Don't necessarily need to flip to go long, but I need to be completely neutral about the way I look at it. So being aware that once you've already done something, you anchor yourself to that decision, you have to be careful that you're not still reinforcing that with the confirmation bias, as opposed to looking at objectively, assessing it, reassessing it, and being more professional about excuse me, the way you're trading it. Number 2, regret aversion bias and loss aversion. Now this is a really common one, guys, and you'll probably know this yourself. I know it myself. You know, as you're trading, especially as you're learning to trade and you're a beginner trader, as you get more experience, obviously these things are still there, but you realize they're not for the benefit of your future career if you keep doing them. So loss aversion, what do you mean by that? We've probably all heard of this thing, and we probably know yourself, is that you want to take profits quickly, and you're frightened, or humans, I'm not saying you, I'm saying human beings generally are frightened about taking loss. We've got an aversion to taking loss. Loads of studies out there, go and check them out on Google, where they go to members of the public in the street and they offer them like a game where you're tossing a coin or whatever, and it's really skewed in the favor of the player if they take a certain outcome, but they'll always not want to take a loss. They'll always want to take what they've got in money and never want to crystallize a loss. Same with trading. You know, beginning traders, newer traders tend to not want to take a loss. Is why a lot of people, you know, pull stop losses out of the market, let things run, don't want to close it. And if you're on the flip side of that, many people want to grab profits very quickly. So that works against you, because what we're trying to do is the opposite of that, of course. So regret aversion bias and loss aversion. Be very cautious that you are just clinically executing your strategy as opposed to literally fearing loss. And if you think of it in terms of, you know, let's say you had a profitable long trade, it's going up, starts to come back down, you know, it can work this way as well. We're like, oh, I don't want it to go, you know, I'm up a little bit, I'm up, you know, that amount of money there, I don't want it to be a loss, I'm going to take it. When in reality, you know, your target may well have been up here, and you need to just kind of look at it completely in an objective manner. Kind of similar things here, really, aren't we? You know, objective assessment, analysis of the trade in front of you at the time. Okay, number 3 we've got is hindsight bias. So, you know, this is something you're doing where perhaps if you're studying and you're looking through the charts, you're saying, listen, I'm looking for a new strategy, a new setup. Hey, I would have taken that, I would have taken that, I would have taken that, I wouldn't have taken that. So you're looking, and if you've watched any of my videos before, guys, you will know that I don't like to cherry pick stuff, and I'm very aware of this hindsight bias. So when we're running through certain strategies or setups or plays, whatever it may be, you know, I want to look for the very first one I see, whether it's good or it's bad. Yes, a good example is nice to see how it should be, but always aware that, you know, the market never is exactly as you want it. If you've got some sort of pullback trade or some sort of trade set up, it's never going to do exactly what you want. So, you know, when you're assessing the market, when you're looking for a new setup, when you're looking for a new strategy, being very aware that you're not, you know, giving yourself too much credit for saying, yes, well, I would take that, I definitely would take that. So being careful and cautious about this hindsight bias. And the other thing, number 4, is familiarity bias. So what do I mean by familiarity bias? It basically means that once you're familiar with something, you're going to go back to it more and more and more and more. Now, I've talked before about becoming a specialist in a market or a setup, so this doesn't really apply to that. But let's just say you're a swing trader, you've made a lot of money trading Apple, you've made a lot of money trading Amazon, whatever it may be, and then but you've got a strategy which is based on long pullback buys. For example, let's say now Apple, Amazon happen to roll over in the next quarter, whatever it may be. You then need to not use familiarity bias and go back to the same stocks or the same indices or the same currency pairs and say, listen, I'm maybe familiar with these, but I need to spread my view a little bit. I need to look at other things that are out there because my strategy is based on that, as opposed to becoming a specialist kind of scalper trader of Amazon or Apple, which is a different thing. So being cautious, you don't go back to the same well too many times. And actually, from a day trading perspective, I have to say I've been guilty of this before. Several years ago, where I would just take the same trade and it was working. And it kind of got to a point where, if you had 3 trades, it was obvious that the 4th and 5th were less likely to work. And you sometimes have to take yourself back out of the situation and say, listen, I'm going to the well too many times here. Yes, I'm selling resistance or whatever it may be, but 3's enough. Let's not just go back. And you get familiar, you get comfortable. So being cautious, you're not getting stuck in that familiarity bias. Okay, and the final one I've got here is self-attribution bias. And what that means is giving yourself too much credit for your performance. We know, you and I both know, that there is an element of luck and randomness in the market. There has to be. There is that, and we accept that, and we appreciate that. So, and if we're thinking, from a casino model, which we've talked about before, if you're trading as a casino, so you're trading with an edge, a casino doesn't know if it's red or black coming up, but he knows that over time he is going to make money. The owner is going to make money, shareholders going to make money, whatever it may be. So he doesn't say, oh yes, the punter has done 4 blacks in a row and it's come up red, I'm a genius. No. So he hasn't given himself credit for the success of his trades. And it's the same with trading, Don't give yourself too much credit for a short spell of success, because a short spell of success may well be that you're a good trader, okay? And accept that, and you don't have to not give yourself credit. But what I'm saying is, don't give yourself too much credit and rely on it too much and say, well, that's exactly the strategy that's going to work. I've had 10 good trades in a row with that. They've all worked very, very well. I'm going to extrapolate that out now to the month, the year, the quarter, and I'm going to go and start ordering my new Aston Martins, my boats, and my what have you. You've got to put it into perspective and say, hey, even if I've got a strong edge, I'm going to have some losers, I'm going to have some down spells. So, not looking at it and saying, well, it's all me, I'm just a great trader. Accepting there's a little bit of luck involved in it, but still giving yourself, a pat on the back when it's due. There's no point in saying you're not, but just being cautious and aware of that. So those are the main ones, guys. Confirmation bias, regret aversion bias. I think they're all different, but they all stem from the same kind of thing, is that it's a human nature element that we have to be a little bit cautious of when trading. Listen, I think that we can harness the power of being a human and harness the power of these and be aware of them, because ultimately, if everyone else is not aware of them, this is where our edge comes in. It's where your edge comes in, it's where my edge comes in. When we've got people who are trading based on these kind of biases and aversions and kind of human flaws, then that's where our edge comes in. And that's where we can make some money, because we're aware of it, we can step back, we can control it, but we can see the crowd getting involved, we can see other people getting involved and take advantage of that. So, interesting there, guys. Any more that you can think of, stick them in the comments below. Always interested to hear what you think about these biases, or any ones that you've specifically struggled with. Other than that, I shall see you in the next video. Take care. Bye-bye. Good trading.